Right. We were discussing yesterday non-resident taxation and international tax. Non-resident and international tax. So, as you all aware, the non-resident taxation, the very basic part, how to determine residency of non-resident individual and how to determine residency of non-resident company or whether it is resident or not. We discussed last yesterday. So today we are going to discuss the balance important part of non-resident taxation. Hope you can see the screen. Can anyone reply me whether you can see the screen or not? While I am moving to the presentation, the way we stop. Hope, yeah, yeah. Thanks. We'll start the session. The yesterday we explained about how to here we stopped here how to recognize the final withholding tax payment. Basically, final withholding tax payment under Section 88(1)(d). Because if it is if you are going to make a payment to non-resident, then we call it as final withholding payment. Then you are required to deduct 14% normally. Then unless the DTA provide, the rate, concessionary rate, then I will explain one by one after going through the balance area. I will explain one by one how to determine the withholding tax each category when we are discussing about DTA. So before moving to that, here we are going to discuss under DTA dividend interest royalty, how we are going with DTA and what IRE access the 14%. So the passive income. Then we will discuss under DTA those provisions, because here we are just moving to the final withholding tax. So just want to highlight that the final withholding tax, there is a relating to non-resident also. That's why here we are going to discuss non-resident, whether it is become a final or not. So then if it is not a PE, here the important point you to remember is, if it is a PE established in Sri Lanka, then you are not required to deduct withholding tax, because PE is anyway is liable to pay income tax. Then they will pay the income tax. If you are deducting withholding tax, then even if it is not become a final, then they have to consider as an income, and they are required to pay tax on that income, and they can take a credit. And how the other countries in the, because India we discuss where the DTA is available with India, then the Indian company can take a foreign tax credit, whatever the tax is paid here as a DTA. Because if it is DTA available, I will, don't worry, I will explain with the diagram when I am discussing with the DTA, with detailed elaboration on with final withholding tax and all. So the withholding tax provision, anyway, we are going to discuss again what we discussed yesterday. So moving to the next slide is basically permanent establishment is very important concept in international taxation. Then the permanent establishment, what it is mean? Permanent establishment. Why permanent establishment is important? So the why the permanent establishment which can be involved where there is no DTA in force in a country. So Sri Lankan permanent establishment, we have a separate section. It's explain about permanent establishment Sri Lankan PE under section 195. You can, if you can go through with the section 195, then you can see what is mean by Sri Lankan permanent establishment. If it is no DTA available, we need to refer the how the permanent establishment determined. So then you can recognize here. If it is no DTA available, we need to go with the permanent establishment as per the Inner Revenue Act. If it is a permanent establishment available with the country, if it is a DDA available with the country, then let's say India, then we can go with the DTA provisions. So because the DTA is more powerful than the Inner Revenue Act, but if the Inner Revenue Act is giving benefit more than the DTA, we can go with the Inner Revenue Act as well. So here the Act says section 195, what is mean by permanent establishment means a place in Sri Lanka. The important part, a place in Sri Lanka where a resident person carries on a business. Where a non-resident person carries on a business. A place in Sri Lanka. Here, you need to keep in your mind a place, permanent establishment, where he established. So, Sri Lankan permanent establishment is the place in Sri Lanka. A place in Sri Lanka where a non-resident person carries on business, or that is at the disposal of a person for that purpose. That is not the technical normal general meaning of disposal of a person for that purpose. That is the place where allocated to that person. The place where allocated for that person. Disposal of a person for that purpose. And include a place in Sri Lanka. Here they elaborate that the place in Sri Lanka where a person has or is using or installing substantial equipment and machinery. It includes a place in Sri Lanka. The highlighted words are very important because you can easily remember this point. The place in Sri Lanka where a person has or using or installing substantial equipment or machinery. Then a small picture, you will get some sort of understanding. The equipment and machinery. If a person is having this kind of thing, then if it is installing a substantial equipment and machinery, then we can conclude that because he has established that business there. Then a place in Sri Lanka where a person engage on a construction. Let's assume the construction. We call it as normally construction fee. Construction. If they are doing or conducting a construction activity or assembly or installation process, then you can see this picture. and have understanding they are doing the construction. But here clearly says for 90 days or more. Clearly says 90 days or more, including a place where a person conducting supervisory activity in relation to the such process. Then here 90 days or more is the keyword. Again, you need to remember the 90 days or more. If they are doing the construction activity, then we can conclude as a PE. Then the examiner might ask how the construction PE is determined. Then whether there is a PE. Then only they are liable in Sri Lanka. Normally, other than the final withholding payment relating to non-resident permanent person, if it is a PE, in order to determine whether they create a PE, then you need to go to the Inland Revenue Act. If there is no any DTA, then you need to go with the Inland Revenue Act. You can decide here. Then you have 90 days. Then they are doing the construction. Then they have a stay in more than 90 days. Then there is a permanent establishment. They have to conclude entire income. Then they have to pay tax on entire income, not the only each transaction. Entire income, they have to compute the business profit, and they have to compute the assessable income from business. Likewise, I will show the diagram at the end of the, because while explaining it's very difficult to do the diagram. Soon after you get this concept, I can easily do the diagram. So then the service PE, we call it as service PE. This picture also very important you to have an understanding of PE concept. Let me explain this one first. The provision of service in Sri Lanka. Here the word is service in Sri Lanka. Service in Sri Lanka, but only if activities that nature for the same or connected project for a period of 180 days or more. The important again, if they are doing a service in Sri Lanka and it is more than 180 days or more, if it is more 180 days in any 12-month period, here they are referring any 12-month period. Any 12-month period. How you are going to determine any 12-month period is now you know. You can go backward or forward to determine 12-month period. Not the year of assessment. Not the year of assessment. Any 12-month going backward or forward. Right? Then a place in Sri Lanka where an agent perform. Here we call it as agent PE. Agency PE. So then the place in Sri Lanka where the agent perform any function. Agent perform any function on behalf of the business of non-resident person. Here, the agent perform any function on behalf of the business of non-resident. Like just assume a country where India, they are doing business in India, but there is a person in Sri Lanka who doing the activity on behalf of Indian company. Then he acting as an agent. And he do whatever the things ask him from the Indian company. He do everything here, including in case of insurance business, collecting of premiums or insurance or is situated in Sri Lanka. But excluding a case involving general agent of independent status. Then the general agent of independent status, then we need to exclude such agents because there are some agent principal relationship, if you can remember, then there are two agent principal relationship. One is dependent agents and other one is independent agents. Then the dependent agents is entirely depend on principal. What principal says, they will do here. They will prepare the set of agreement, they will sign then they will execute the contract, they will sign agreement, they will enter with, they whatever the principal asks, they will do here. Then that is called the dependent agent, entirely depend on. Then the financial support, if they ask uh, them to do this one, they will do it. If they ask them to don't do this one, they will do it. So they will comply with that. So likewise, they entirely depend on the principal. In that case, we call it as principal agent. Here it's explained in detail in the DTA, also in the agents principal relationship under permanent establishment. We will discuss that part as well when we are discussing the DTA, right? The agents here. Then you can see here whatever the agency, permanent establishment, we discuss the 5 areas. The place, if where it is, the place, the PE, automatically will get it, the permanent establishment. Then if it is machinery install, then I kept here few pictures you to understand clearly. So the construction PE and the service PE here and the agency PE. So these 5 PE concept is important when you are reading. This is the main PE place, and other 4 also important you to have how to determine. Then in this case, what you need to remember is here agency PE. Basically, agent is dependent agent. Then the machinery, how the machinery is create its installation. This one we discussed. Machinery has using or installing equipment or substantial machinery. And the construction PE. Construction PE, here the construction PE, it is related to 90 days. And the service PE also related to 90 days. It says 12-month story. Here, no any 12-month story, they just say the 90 days. Here is the main one. So this is a snapshot of the PE related to Inland Revenue Act. Then we are moving to computation of income tax liability. Computation of income tax liability. Then how we are going to compute the income tax liability of a non-resident person. How we are going to compute the income tax liability. So it is not difficult task. What you have learned up to now, normal company, the same principles are applied for non-resident as well. So in that case, you need to keep in your mind what are the allowable expenses, disallowable expenses, those adjustments you need to do as it is. Then the important thing is, if it is do you need to categorize employment, business, investment, and other sources. As we discussed previously, the same provision here applicable non-resident as well. So the key differences are important to keep in your mind. The one is tax-free allowance. Tax-free allowance, I will explain through the whiteboard. Tax-free allowance, how it's applied for a non-resident. Tax-free allowance is one of the key area you need to remember when it's come to non-resident person. So the tax-free allowance, you need to categorize, and I will ask because you need also engage with this lesson. So how to determine the tax-free allowance each non-resident and citizens. So the non-resident and non-citizen individual are not entitled to tax-free allowance, but non-resident citizens are entitled to tax-free allowance. Tax-free allowance. Non-resident citizens are entitled to tax-free allowance. What is the tax-free allowance for a individual? Can anyone tell me? As per the previous law and the with amendment, what is the tax-free allowance? With effective from January 1st, 2020, and previously what we have, the tax-free allowance. The previous law 375, no, 750 for last 3 months, right? Right. Who else? The Yeah, others. I got one answer. I will also explain using the whiteboard. It is very important you to have this understanding for your exam. Here, still question is open, you to reply. The others also can reply. The new law and previous law. The new law is amendment. After the amendment, including the amendment, prior to January 2020. Here, after 1st January 2020. So these two periods you need to clearly understand how you are going to determine whether it is the tax-free allowance. You all aware there were two kind of allowance, because just I am going to have a table kind of thing. I will do a table here, and as well here also I will draw a table. The one here we can divide it into we can divide it into 4 area. The first one is there are persons here, right? I will explain how to this is the important part for you, how to decide. Till you can answer the question. till I am draw there. Right. And here I will draw this way. Yes. You know that personal allowance and I need to reply from you. I need reply from you, personal allowance as well as when I'm asking questions, uh, I can see. Right. Anyway, citizens. I see mention is as citizens, and here we can categorize non-citizens, right? And again, I'm going to categorize here resident, here non-residents, here again residents. There may be non-citizens, they are residents. So again, non-citizens and non-residents. This right, and then here also the same. C for citizens and non-citizens and residents and non-residents. Here again residents, non-residents. Then you can identify personal relief, personal relief, personal relief. Here, what is called it as personal relief, right? Here, I can mention the personal relief, relief, relief. Here, what is we had in the previously employment, employment, employment relief. I will, in short form, I will say employment relief. Here also we have personal relief and the employment relief. Is it employment? Is it employment? No. Expenditure relief. Expenditure relief. Expenditure relief. Right. Then I need favor from you. What is the amount we allocated for personal relief during this period? During this period, what is the amount? Only one student who is replying me. Yes, you are correct. The here we have 500,000. Previously we had 500,000 personal relief and the employment relief 700,000. Right? And here the personal relief is how much? Not only 3 months. I am referring from this to entire is 3 million. 3 million. I will put million, right? 3 million. Here expenditure relief is how much? 1.2 million. 1.2 million. Then for 3 month applicable portion, how much is the 3 month applicable portion? 3 month applicable portion is 750 for 3 months. If you can divide it by 12 multiplied by 3 million you can divide it by 12 multiplied by 3, you will get 750. Here 1.2 million, if you can divide it by 12 multiplied by 3, then 300,000. These are the amounts applicable for 3 months, right? 750 and 300, right? Then can you explain how the personal relief will get citizen is see here. Can you see my mouse pointer? Can you see the mouse pointer? Otherwise I need to get the highlight. Yeah, okay. Here C is citizen, and then the resident, citizen resident. Do they get personal relief? Do they get personal relief? Yes, they will get personal relief. Then will they get the employment relief? Will they get employment relief? Because they are citizen and resident, they will get employment relief as well. Then citizen, non-resident, will they get personal relief? Will they get personal relief? Citizen, non-resident? Citizen, non-resident. Because here the important part for the non-resident perspective. Yes, they will get as per the section 52, right? As per the section 52, they also will get the relief. And then will they get employment relief? Will they get employment relief? Will they get employment relief? No, they will not get employment relief because they are non-resident. The non-resident, whatever the income they earn, subject to the personal relief. If it is citizen, they have to pay only by taking this 500. Only by taking 500. If you can refer the pay table 4 is, if you are referring the pay table 4 is applicable for non-residents. If you can apply the refer the pay table, you can have this understanding. If you want to double check on this. Then the non-citizen residents, non-citizen resident, whether will they get personal relief? Yes, of course, they will get personal relief. Will they get employment relief? Since they are resident, they will get. Then non-citizen, non-resident, the important part again. Non-citizen, non-resident, will they get personal relief? Can anyone tell me? Will they get personal relief? Non-citizen, non-resident. Non-citizen, non-resident. Will they get personal relief? Here, they will not get personal relief. As well, they will not get employment relief. Right? Then the new law is also applicable. You need to critically analyze this. This is mind map, because it is important for your exam as well. Here, the personal relief. Personal relief in the case of citizen resident, will they get personal relief? Yes, exactly. They will get. The expenditure relief. Expenditure, what are the expenditure relief kind of? The new one, they bring into the law as amendment. The new one. Uh, New one. This is actually what are the expenditure? The if you have medical insurance, medical expenditure, you can go up to 1.2 million. If you have housing loan, if you purchase in equity market, then you can get that expenses as well as a deduction under qualifying payment. Then if you have education expenses of your or your children, local education expenses, not the foreign education expenses, that one also you can go up to 1.2 million. Those things are newly implemented as a personal expenditure relief. It is very important you to have understanding on that. So, and then one thing is again the contribution made to the pension scheme. Pension scheme, we don't have much pension scheme. We have only a few banking businesses, they have approved pensions. Then because the pension scheme they have introduced, because the government employees having the pension scheme, the private sector in order to encourage this pension scheme after the retirement, because if they also have such kind of pension scheme, that would be better for the other after the retirement. That's why they need to encourage, government want to encourage pension scheme. Then that kind of scheme, if it is there, then that amount also can be deducted as a qualifying payment. So then those 1.2 million also can get from the citizens, non-citizens who are resident in the particular year of assessment. So then citizen non-resident, will they get citizen non-resident, will they get personal relief? Yes, exactly, they will get personal relief. And the citizen non-resident, will they get employment relief? Will they get employment relief? They will not get employment relief because they are non-resident. And here the non-citizen residents, they will get personal relief and expenditure relief as well because they are residents. Then here non-citizen, non-resident, they will not get personal relief as well as expenditure relief because if they become a non-resident, basically their expenditure basically they will have outside Sri Lanka. They will have expenditure, some kind of education, medical expenses, they are not incurring here. That is why they are not allowed to get here. They will have outside Sri Lanka, the country where he is become a resident. So that is the basic concept. This mind map is very important for you to identify. In the case of here, I will mention your years of assessment applicable is basically, this is the previously, I mean year of assessment. What year of assessment? 2018, 19, and the year of assessment 2019, 20 up to December. Up to December. December 20, up to December 31st, 2019. Here, this is the basis, right? Here, with effective from 1st January is for a 3-month period. In the year of assessment, your year of assessment 2019 20 20 3 month with effective from 1st January 2020. In that case, for you is 3 months. Then you need to proportionately apply for the 3 month and 9 month, like I mentioned below, the 750 and 300. Here also we need to apply proportionately for your year of assessment. It is applicable for only 9 months. Here the 9 month. In the case of your year of assessment, you need to apply this one for 9 months. The personal relief, if you can, the 500 divided by 12 into 9 is how much? Is how much? 300 and 345. Is it correct? Am I correct? Then 700 divided by 12 is how much? Multiplied by 9 is, yes, 5, 375 and 375 and here 525. 525 is for 9 months. Here it's, as I mentioned, 3 million for your year of assessment is important, divided by 12 into 9, how much is 750,000. Then the 1.2 million divided by 12 into 9 is equal 300,000. Here this is expenditure relief, ER, expenditure relief, and this is personal relief, PR. Likewise, this is also you can categorize PR, personal, personal relief, sorry, personal relief, and here the employment relief, not the expenditure. This is a employment relief. Right. This is how applicable for your year of assessment. I will mention your year of assessment as well for your easy understanding purpose as mind map. For your year of assessment, it is the year of assessment 2019-20. Here also your year of assessment is for 2019-20 only for the 3 month. Here you can mention for 3 month. 3 month. Here you can mention as 9 month. Right. Hope you get this understanding properly. I will share this mind map as well with you. Then move into the slide again. Here now you have understanding of section 52 with the amendment. And then the remittance tax, also important, remittance tax under section 62 and 52 and 62, right? The remittance tax. The non-resident is chargeable with remittance tax under section 62, in addition to the income tax, so far as such person carried on a business in Sri Lanka. Non-resident is chargeable with income tax. Non-resident is chargeable with income tax in addition to the income tax so far, right? In addition to the income tax, they when they are carrying on a business in Sri Lanka, they are required to pay remittance tax. What is the remittance tax rate applicable for non-resident? What is the applicable rate for non-resident? Remittance tax is clear, 14%. Anyway, we are going to discuss in few minutes the remittance tax as well. So then again, non-resident perspective, other important adjustment is the head office expenses, because this is again related to DTA. DTA also some DTAs, they allow the head office expenses entirely, but some DTAs they do not allow head office expenses. It is subject to the local law. The India is subject to local law. If you take India here, India, they refer to the local law. Local law in the sense the Inland Revenue Act. It is, they refer India DTA, they refer to local Inland Revenue Act. Then you have to go with this provision, section 79. Section 79 is important section in the case of non-resident. Then the 69 is important, 52, 62, 79. Those provisions are very important when you discussing with non-resident. Then the head office, I will explain. No deduction shall allowed for amount incurred by a non-resident. No deduction, right? No deduction allowed. Allowed in the case of non-resident. No deduction shall be allowed amount as incurred by a non-resident as expenditure for the business to when they are conducting as a non-resident to a Sri Lankan PE that represent the head office expenditure. Normally, let's say take a company where he is a non-resident company and they make head office expenditure. Then we can't deduct entire head office expenditure in full to the P&L. We can't charge entirely head office expenditure. So what we need to do is we need to adjust that head office expenditure, the allowable limit maximum 10% of the person's assessable income. 10% of the person's assessable income, you need to adjust it. 10% of person's assessable income. Then you need to take assessable income. Then you need to take 10% of the assessable income. If there is any head office expenses, what we need to do is we will excess amount. What we will do is we will disallow. Right? Excess amount, what we will do is we need to disallow. Only the allowable portion we can allow as expenditure. Whatever the amount charged to the P&L, we subject to this rule, we can allow it. Other additional amount, we need to add it back. The plus minus, we need to get as a plus amount. So here you can see this example, amount incurred during the year by a non-resident person. Then let's say 200 they have incurred. Then the assessable income is 1000. Their assessable income is 1000. The maximum amount deductible is minimum of 10% of the assessable income OA. This is the maximum amount is 10% of the assessable income. 10% of the assessable income is basically what it is, 100 million, 100 million. Then the balance amount, what we need to do is 200 minus 100. 200 minus 100 is balance 100. What we need to do is disallow. Balance 100, we need to disallow. Right? Then that is how we need to do the calculation. The head office expenses. Then another important section as per the previous Inland Revenue Act under transitional as well as the transitional provision. Deemed profit. Deemed profit. Section 83 in the previous Inland Revenue Act. And the transitional provisions also allow the same. I will explain the deemed profit. Deemed profit, how this deemed profit comes into effect. The deemed profit, let me share the screen to the whiteboard. I'll clear this drawing. The deemed profit is the where the you just take a non-resident company. Those non-residents, they are not able to prepare account. Most of the non-resident project company, they came here, do the project and the construction, some kind of road development, highway project, some kind of bridges, hospital construction, bigger construction activity. Some foreign company that with their technology, engineer expertencies, those kind of things we required, because we the Sri Lanka, we believe that we don't have that technical expertise. That is why they give this opportunity to the foreign companies. They bring into here, they bring in their technologies and all, and they do the investment here. So then those non-resident companies, their language, they say China, they are not willing to convert their single word into English even. They want to do the accounts and entire things in Chinese language, in Chinese. So they're not willing to convert even in one single word other than numbers, right? Then very difficult you to have audit or they have understanding of financial, even they are not preparing according to the GAS, Global Acceptance Accounting Principle. So then very difficult, and they don't have any record properly. If you have experience, some kind of experience in foreign Chinese companies, they don't have that kind of set of accounts and procedures. But that is why the deemed properties came for them to they in order to get them also into the board taxnet. They introduced the deemed profit. They introduced deemed profit under previous law. What they will do is the particular year of assessment. Let's say the year of assessment. In your case, also I will take the non-residents who not prepare accounts. Non-residents, non-residents, non-residents who not prepare financial statement. Let's say financial statements. Then they can go with deemed profit. Deemed profit. Profit is assuming, they are assuming the profit how much? Based on the percentage approved by the Inland Revenue Department. The non-resident companies, here then what then I'll explain in your year of assessment. Let's say by taking the previous years as well, 17, 18, 18, 19. and 1920. Right? These are the 3 years for your perspective, because this is also very much important. In the case of non-residents, those who not prepare accounts, if examiner give, they have taken deemed profit approval in the prior act, the previous act. It is the year of assessment. Let's say year of assessment 2017-18. Then the year of assessment 2018-19. This year is your applicable year of assessment 1920. Here, let's assume they have taken a deemed profit approval in order to prepare the taxable income, assuming that they are going to calculate on deemed profit basis. Let's say this year, what they do is they will not do the accounts here. What we need to do is they will just have revenue detail. What they will do is they will in this year uh, what they will do is they will, because in this period they are required to pay anyway tax, no? They need to take the amount as, let's say, 100 million worth of amounts they have as a revenue. They have 1,000. What they will do is, because it is coming with the previous Inner Revenue Act, the deemed profit. That is why I have taken the 1718. Then the revenue they have 1,000. The rate is, deemed profit rate is for them, deemed profit rate is 10%. I will take deemed profit rate given by IRD is 10%. This is the rate given by the IRD as per the section 83 of the previous law. IRD as per the section 83 of the previous Inland Revenue Act. The previous Inland Revenue Act. So that is the rate they have given. Then the 10%. What they will do is they are going to calculate now how much the deemed profit. They will do that is called the taxable assessable income from the business. Then the deemed profit is equal, the deemed profit is assessable income from business. Is how much they will get into 10% equal 100. Then this is the profit, the assessable income from the business. Then what is the amount they need to pay tax? The tax amount they need to pay, how much? The tax they are required to pay as a tax is 100 million into applicable rate. For the constructions, the previous law they had 12%. Then they will pay 12 million to the IRD. And also together with remittance tax, in the previous law they had remittance tax 10%. Right? Then remittance tax also they need to calculate according to this. This is income tax. Let's say construction here, or as normal business, it will take assuming this company as a construction business, income tax 12%, and the remittance tax, how you are going to calculate the remittance tax? Remittance tax. How you are going to calculate the remittance tax? Can anyone tell me? Uh, how you are going to calculate remittance tax? I will use this color, or else it will. Right. How you are going to calculate remittance tax is, this is the profit. We need to deduct whatever the income tax they did paid, and then how much the amount? 88 into 10% is remittance tax is then 8.8 million. This is how the previous law you calculated, right? Then when it's come to your year of assessment, when it's come to your year of assessment, then it's slightly different. This is, I'm just assuming as a construction business. Here I'm taking your year here, for example. Right. Then, can anyone tell me what is the year, in the year of assessment 1920, how we are going to determine uh, remittance tax and the deemed profit provisions in the year of assessment? Then assume that they have taken the approval in the 1718, 10% deemed profit under the previous Inland Revenue Act. So, if they have taken under the previous Inland Revenue Act, then they can continue the same basis for the year of assessment 1919, 1920 going forward. If they continue the same business, the same project. There are some companies where they have project, the, like I said, construction of water plant, maybe the highway project, the hospital project, kind of those kind of project they will have. The normally currently they are having water supply project, water plant project, and the normal highway project also. Then those companies and also the big investment activity they are carrying on. Then those non-resident companies, they are not preparing accounts. Then if they came into Sri Lanka before the new Inland Revenue Act, they have already taken that approval deemed profit. Then they can continue the same basis in this year of assessment as well. This year of assessment. That means 1819 and 1920 as well. So then I will explain in year of assessment 1920 for your year of assessment how you are going to calculate, uh, the deemed profit basis for the 1920. I am not going to calculate 1819 because if I take the 1920, I can divide it into two period exactly where the changes also happen, the 3 month and 9 month. because the changes applicable with effective from January 1st, 2020. In this 1920 year, I will explain here the 1920 full year. If it took entire year, this period we have normal previous law, and this period 3-month period we have the different rates basically. Then the previous law, the construction industry, we had a different rates. Now we are having different rates. So the 3-month, because construction businesses, because I just highlighting this too, because under previous law, construction companies, they paid tax at 28. This period, the tax is, they have reduced to 14%, because these things I have already discussed in the very first sessions, this 3-month and 9-month period, because here the 3-month and 9-month period applicable, right? Then construction business, then they can continue the same basis according to the deemed profit approval, because they have taken in the previous law, under the previous law, as per the transitional provision, they can continue the same basis. They can continue the same basis. So I will explain this scenario under these three different two period. Let's say that this year they have revenue. They have revenue. I will use same color format which I used previously. Revenue. They have 1,200. Let's say 1,200. They have revenue. Then the apportion revenue for this year, the 3-month is revenue applicable for this period. I'm taking 900, and here I am taking 300, right? Sorry, it should be 300, right? Right? Then, because they have taken a deemed profit approval to compute their assessable income, it is 10%. Then the deemed profit rate is, we know that 10%. Deemed profit rate is 10% for this two period. No issue, both period 10%. 10% for both period. Then what we will do is we need to calculate then the deemed profit, basically assessable income from business, two different period. Assessable income from business, we call it as same word in deemed profit, or else assessable income from business. Assessable income business. This is how we are going to calculate 900. Can anyone help me on calculation? Then the 10% is how much? The amount is 90. Then here 300 into 10% is equal to 30. This is how you need to calculate deemed profit. Right? I will not keep a space. Right. 30. Then the income tax is how much? Income tax. Can anyone help me on income tax? How income tax applicable for this business construction is 28. 90 into 28, how much? 28%. 90 into 28%. Yes, 50, 25.2. 25.2. Then, then, right. Then, here, how much the tax amount? 30 into income tax is how much? Can anyone help me on this? 30 into rate is applicable for 3-month period based on the new Inland Revenue Act, a new amendment. The 14% into 13 to 14%, because the now is 4.2 million. Yes, they are active students, even though others are sleeping. Uh, then the remittance tax also you need to calculate the remittance tax. Can anyone help me on the remittance tax? The remittance tax is how much? Remittance tax. How you are going to calculate remittance tax? 100. Is it 100? No, 90 minus what they have paid in cash income tax, 25.2 million. Then what is the amount? The balance amount. The balance amount. Because this year is the applicable for your exam, not the 17-18, right? The 90 minus 25.2 is 64.8 into how much? The percentage is for remittance tax 14%. Then can anyone tell me 64.2 is how much? Then the 64.8 into 14% is 9.072. 9.072. Here also you need to calculate the same basis as it is the remittance tax. How you are going to remit is what the 30 million is the tax amount, then you can deduct whatever the income tax paid, and the balance amount is how much? 25.68, 25.8, yes, 25.8. Then it is into 14%, because the remittance tax didn't change. Remittance tax as it is. Then the amount is just check others also. The amount is 2.612. Yes, 2.25.8 into 14%, 2.612. Yes. And this is how you need to calculate 3 month and 9 month, including if it is a deemed profit company. If it is a deemed profit company, this is how you need to calculate the income tax and remittance tax. I will share this one with you as a short note. Uh, and I'll move to the tute again. Here, what we have discussed. However, the important part, as discussed already, Inland Revenue Act number 24 of 2017 does not provide that deemed profit basis non-resident companies are now required to prepare financial, even if it is China or even whatever the language they are preparing, they have to prepare financial statement. But there is a concern with the Inland Revenue Department. They are in discussion. We also requested them to relook at the Inland Revenue Act with the amendment, whether they can bring this deemed profit basis to the new Inland Act. They also thinking about that deemed profit because they also benefited if it is deemed profit is there, because if they are preparing account, they that people definitely they will prepare on loss basis. Therefore, deemed profit is one in one hand it is benefited for Inland Revenue as well. So they will relook at this provision whether they can bring it to the new Inland Revenue Act. So until such time, they have to prepare account uh, for the companies who are starting after 1st of April 2018. Then there is no any deemed profit. If they have taken prior approval in under previous Inland Revenue Act, they can continue the same basis. If it is similar business, they are continuing. Right. Then I'm moving to the remittance tax. Anyway, I no need to go in detail because I did the remittance tax calculation there. The remittance tax is because basically remittance tax is coming. The remittance tax is because what the because there is no any sharing as a dividend, because non-resident company what they will do is since there is no any shareholding, because non-resident company the parent company is somewhere else, then they bring it to here, then they start a branch or some other mode of registration as a non-resident company in Sri Lanka, non-resident company in Sri Lanka, and there is no any distribution of dividend. Basically, that is the mode. There is no any distribution because there is no any shareholders here. That is why the remittance tax is implemented, because the main concept is because if it is a dividend tax is there, definitely we can get it 14%. But in the current law amendment, then if you pay dividend to non-resident, this is now exempted. So the 3 month period with effective from January. Previously, it is anyway subject to withholding tax, 14%, that as a final withholding tax payment in the case of dividend. But the dividend for the non-resident company, then the previous Inland Revenue Act, 3 month and 9 month, we need to take it carefully. I will explain with you the dividend scenario also when we are doing the when we are doing the DTS, I will compare the provisions both the remittance and dividend tax when we are discussing the short while regarding the DTA, when we are discussing the DTS. So the no distribution of dividend, however, non-resident person who carries on business in Sri Lanka through a PE would remit its profit to head office. Definitely, they will remit profits to head office like this. They will remit. So then, what they will do is they will remit the profits to head office. The highlighted words are very important outside Sri Lanka. Then, therefore, in lieu of dividend, what the Inland Revenue will do is they will charge tax on that amount, remitted amount, that is the remittance tax, it is 14%. Then the when the if it is remittance tax is applicable, when we require to pay remittance tax is payable to Department of Inland Revenue on or before 30th day of succeeding date when making such remittances. Then let's say if they make uh, January 30th, they are going to make the remittance. Then the within 30 days they need to make the payment to the IRD as well. Basically, what they will do is in practice they need to take a clearance in the when they are making remittance to the head whatever the outside Sri Lanka. Then they need to take a clearance from Inland Revenue Department International Unit. So then here, what are the remittance profit? Basically, remitted profit means it also you can refer the section 62. You can have understanding this definition is given. The remitted or retained abroad. Then there may be a mode of remitted. Then whatever the income they earn here and they are going to remit. This is the part of sending part. And also the retain in abroad. Retain in abroad means that properties belong to Sri Lanka, but they retain abroad because the most of the company they have onshore and offshore supplies. Onshore means what they are conducting, carried out activities carried out in Sri Lanka, and the activities they have done in outside Sri Lanka, kind of design and management consultant activity they will do in, as well as they will supply equipment to Sri Lanka to the have a business. Then those activities are subject we call it as outsource offshore offshore supplies. Then the onshore part is they will have a profit. Then the offshore part also it is attributable to Sri Lankan PE. Then that one also liable to remittance tax. Then they have taken together as a uh, entire profit, and they need to consider as a uh, when they are making payment as a remittance tax, right? The retained part and the remitted part. Outside here, the explanation is given, excluding the dividend paid by a resident company to an unresident person. This is the exemption is the because if it is dividend paid, then we can exclude which is not subject to remittance tax. Here the small whatever the para summarized version is amount remitted or retained amount remitted or retained board outside of the profit out of the profit that are subject to tax is 100. Then the amount received outside Sri Lanka on behalf of non-resident person who conducting business in Sri Lanka, that is the amount received in relation to the business conducting in Sri Lanka, the two way. It is also subject to here in this para also you can read carefully these two here the in the table it is summarized the whatever the amount received out from the outside Sri Lanka on behalf of non-resident person who conducting business in Sri Lanka. It is let's say 100 altogether 200. Then the tax on remittance tax is A multiplied by 14% is we need to pay is directly 14%. But this is not the case when we are applying the scenario, the entire amount. This is the remittance perspective explanation, but you need to pay income tax here. Then after deducting income tax, then what we did in the whiteboard previously, that is how we need to calculate the remittance tax. You keep these two only. You can get these two only from this slide. Then the calculation part we did as we discussed previously. Here we are moving to DTAs now. We can finish DTA as well today because yes. residents. Here, as you aware, because I'm not going to discuss again and again because we discuss these things. The resident person is chargeable global income. Resident person is chargeable global income, and non-resident person and non-resident person also chargeable. Non-resident person, in the case of non-resident, non-resident is chargeable income arising or derived from a source in Sri Lanka. Income arising or derived from a source in Sri Lanka. Here the source, the non-resident perspective. The resident perspective, resident person perspective, resident person is basically, you know that global income is subject to income tax. Then in the case of non-resident person, only the income arising or derived from a source in Sri Lanka. This is very much clear for you. I'm not going to again and again elaborate because this is the key point of when you are writing the answers, because the resident and non-resident principles. So, if a similar provision prevails if the tax laws of other countries as well, then just assume case where the resident person, uh, they are subject to tax, as a resident company in that country, as well as if he become a resident here. The similar provision prevails in the tax law, other country as well. Then the particular income could be taxable in two countries. Basically, in one country, again they will tax it other country as well. Then if it is similar provisions of prevails, then definitely you will get tax both countries. So what you need to do is, in the case of avoiding double taxation, resulting it occurs a double taxation of such income. Here you will face double tax scenario if we become even the resident is world income is liable, then the non-resident is income source in liable. let me let me explain in the whiteboard. It is very clear I can clearly explain that one. So let me clear this drawings. Right now I am drawing here, then you can have better understanding. Here as a company, it is resident in Sri Lanka, Sri Lanka, resident company in Sri Lanka. Then if it is physical cars, I can explain a bit more on the using the whiteboard, and it will easy for you to understand with the example, with the names and all. So but we have to do anyway this one continue at the end of the sessions because due to COVID. So the non-resident company, this is uh, in India, right? We say it is India. Here it is Sri Lanka. Here Sri Lanka. Here this is company. There it's in India. They are in India, right? Then what they are doing is basically, if they are providing service to Indian company, then according to the source principle in India, we whatever the income as a non-resident we are getting from India, whatever because we are providing a service to India, then I will I would say here we are providing service. Other way around, last day we discussed uh, they are providing service. Here, Indian company they will pay for that service. Then they will make a payment. But as per the Indian law, just assume that they have deducted our service value is 100 million. They deducted whatever the applicable taxes and they paid only 90. They deducted 10% as their taxes in the source they have deducted because then our world income is liable for tax in Sri Lanka. Then the world income is pay taxes. Then we need to consider because it is resident. Then we need to, if they are we providing outside Sri Lanka any service, but here we need to consider world income. World income, even if it is become a resident, we need to consider world income. They have local supply as well. Just assume they have local supply as well. Well, the local supply the, the highest amount from local supply as well is uh, here the local supply the resident company they are providing local supply, let's say local supply, all right. And then here we have local supply, then we earning 900 million here doing local supply, but again we have outside, then the world income entirely here 900 plus 100, the entire 1000 is liable for in Sri Lanka. Then the world income is subject to tax in Sri Lanka as a resident. uh, then then whatever the taxes, then the Sri Lankan, because we subject to tax world income, then this assume no any deduction and allowable and disallowable adjustment, then the entire 1000 we will consider as assessable income from business, assessable income from business business then entire 1000 we will consider as a business and tax at 28% as a normal company, because I am not going to complicate this one 28% and 24% 3 months and 9 months, because of I need to take a time to reduce detail elaboration. Therefore, I will just say 28%. 28%, then you need to pay tax 280, right? Then 280 is the amount you need to pay, right? Then as a tax, then whatever the taxes they have paid in India also they have tax burden, and entirely they are liable subject to tax in Sri Lanka 28. They have paid 28 280 and they have paid in India also 10. Then altogether they paid 290. But actually they are, since their world income is liable as a resident company in Sri Lanka, they would have paid only 280, but they paid 290 because of the India, because the same provision is applicable. Then what they can do is in order to avoid this situation, what they can do is, can anyone tell me how they can avoid this situation? How they can avoid this situation? They can claim foreign tax credit. Whatever the taxes paid outside Sri Lanka, they can take foreign tax credit. Foreign tax credit as 90 is 10 they have paid in India. Then only the balance amount they need to pay. Only the balance they need to pay. The balance amount is Anyway, 270. 270 is the balance they need to pay. Balance payable, basically. Income tax payable. Yes, payable. Right? Hope you understand the concept clearly. Then we'll move to the session again. Slide. Then the prevailing similar provision prevails in tax laws, other countries as well. Then similar provisions mean this provision. This provision is the basically this one, the main one. Similar provision is global income resident person, the source principle for non-residents. Similar provision other countries. Then a particular provision a person could taxable in two countries and result in double taxation on such income. Accordingly, what we can do is we can have a DTA in order to avoid. That is why the tax credit I have mentioned. It is available in the Internal Revenue Act as well, foreign tax credit. Then under the DTA's important question addresses who should be taxed on income. Here the important word is who should be taxed on the income and who should get provided tax relief as a tax credit. Accordingly, alternative positions are available. But first one is residence principle. Resident principle. Other one is source principle. Other one is revenue sharing principle. The resident principle is tax should be levied by the country where the taxpayer is resident. The tax should be paid by the resident. The resident principle also there. Then the tax should be levied by a country within the territory the income arise. That is source principle. The income arising or derived from a source in Sri Lanka. We have this principle as well. The source. The revenue sharing principle is the tax should be shared between two countries. Then the tax is sharing. Then if it is tax is paid entirely one country, then they are sharing this tax. Then they are sharing. This is not popular. We have the resident principle and source principle. So when we are discussing double taxation, they have designed this model. They have used this model to design the DTAs. What is mean by the model, tax model? As I will explain this one, it is very easy you to remember. You just take when you are preparing an agreement, even if it is audit firm or when you are sending engagement letters, maybe whatever the template you are taking, you will take the template as it is. You will modify the template using the client name and other things, right? The amounts and other. Even the account that you will use a ABC format and change it. Then as well as if it is you are going to create an agreement, you will take the agreement sample agreement format and you will change accordingly. If it is you are going to change the letter, you will take a copy of the previous letter or else you can take a fresh template letters and you can modify accordingly. Likewise, the agreement DTA also they have prepared this kind of model. They have two model, OECD and UN model. OECD model mainly developed countries are using OECD. OECD, I will use the laser point. The OECD is that model. Normally they use developed countries. Here you can see developed countries. They are using the developed country. That is the main difference. First difference, the developed countries they use. UN model is mostly used developing countries. More developing countries, right? Then the OECD model, they use the principle resident principle. Then if it is resident, they are required to pay taxes, right? Then they emphasize the tax here, the basically capital exporting country primarily, that is developing countries. So the favor to resident principle, right? Then the UN model basically source principle, because the source principle is because in order to develop in countries, they want more revenue. If it is developing country, they want more revenue. Then source principle is important because uh, if they create a source in Sri Lanka, then we can tax it, because if you go with the resident principle, definitely most of the companies, they will become a non-resident, then we cannot collect any taxes. Therefore we go with the source principle. That is why Sri Lanka also going with UN model as a developing country, because source principle is very much favor for us in the case of when we are taxing non-resident person, then we can go with the source principle and catch them and tax it in Sri Lanka. That is why these two model mainly, there are two differences. First one is OECD resident principle, here source principle, and the OECD mostly use developed countries, and the UN model is used basically the developing countries. These are the two main concept, the difference. Then these model they use, and sometimes they pick from some article from one model and other article from one model, that mix utilization also there. Then most of the articles, if you can have a look at the OECD and UN model, if you want, you can request me the UN model and OECD model, both models I have, I can share if you interested in. And if you go in with deep taxation of international, then I can share the UN model and OECD model templates and all there. Then these two models are mostly used by when they are developing a treaty between two countries. Most when they are designing treaty, basically the our inland revenue senior officers, basically Commissioner General plus Deputy Commissioner Generals and international unit heads. International unit, they have a separate unit for international taxation. Then those people will visit to that country, and they, because the you can see here the negotiation and enter in double taxation agreement too. Here then they will negotiate one each other. If our peoples are more knowledgeable, then they will try to take source principle, and they are try to catch all the income here. So then they can have a discussion with each other countries, and when they are entering into double taxation, our tax senior people in our department, deputy commissioner general, commissioner general, sometime may go, sometime he will allocate to some other senior person, deputy commissioner general, and the senior commissioners and the international unit head. So they will go to the relevant country, and they will have a negotiate with that particular country's tax authority, and they will have a negotiation with each other, and they will finally end up with the agreement and sign it and finish it. Then they will publish in the gazette form, that is called double tax avoidance agreement. So they will use these two model to have to in order to develop the agreement. So that is how they have developed. We have up to now DTAs 45 countries with we have 45 countries DTAs with 45 countries as at 31st July. Even now itself it is 45 countries, right? Then these days also they are negotiation with some other countries to have a double tax avoidance agreements. Going on, will increase the numbers. Here, again, double tax avoidance agreement in accordance with the domestic principle of laws of Sri Lanka, where the DTA is in force. GTA impose, here the important concept, the term of DTA. The term of DTA override the provision of the domestic law. It is override the domestic law. Clearly, you need to be mindful. It will override the domestic law. In determining the attributable to taxation of profits and income of non-resident, then they definitely override the domestic law. If it domestic law is 14%, if it is DTS is 10%, we can apply 10%. That's it. Then they are overriding the uh, local law. That is the Inland Revenue Act number 24 of 2017. The domestic law mean, right? Then, however, if a provision of IRA is more beneficial to a non-resident, if it is IRA is more beneficial, the benefit of such provision should accorded to the taxpayer. If it is IRA is more beneficial to non-resident, then the benefit of such provision should be accorded to the taxpayer. What it is benefit scenario? The interest income, Inland Revenue Act says 5% previously. Now it's changed with effective from January. The biggest change they made it with the new government. So, but the previously up to 31st December 2019, the 5% is the interest, withholding tax on interest. But most of the DTAs, they said 10%. Then it is beneficial to go with 5%. Why we are going with 10%? So then we can apply 5% and we can pay, they can pay taxes 5% only by applying the domestic law, that is Inland Revenue Act number 24 of 2017. That is applicable for only for the 9-month period for your year of assessment. So I will segregate that part also when we are analyzing that part, and the interest income which sources separately, because it is more relevant to your individual assignment as well. And the permanent establishment, in the case of DTAs, the permanent establishment also important concept you to have understanding. The permanent establishment also we are going to read one by one. Here the permanent establishment is basically, we can go with what we have discussed. The same principles apply. Here the first one is permanent establishment. If I read this one, the concept of PE use, PE short meaning is PE is the permanent establishment, is used in double tax avoidance and tax profit from business conducted in other contracting state. Basically, PE concept used to avoid double tax avoidance to tax profit from a business conducted in other contracting state. It is basically said that business profit is taxed under DTAs only if there is a PE situated in other country. That is the important part. The business profit, keep it in mind, the business profit, not the other income. Business profit is taxed under DTAs only if there is a PE situated in other country. Then the business profit, not the dividend, interest, rent, royalty. The dividend, interest, royalty, not right. The business profit, if they are conducting business profit is taxed only if the case where if it is become a PE. If there is a PE, right of, if there is a PE, the right of contracting state to tax attributable profit. Here, if there is a PE, we need to tax by taking attributable. Let's say Indian company, they are doing business here. We go with this PE concept and determine, right, according to the DTA with India, right, there is a PE in Sri Lanka, right? There is a PE in Sri Lanka. Then we are going to tax entire company profit. Are we going to tax entire company profit? No. We are going to tax only the profit attributable to that PE. Profit attributable to that PE. So we are going to tax the profit attributable to that PE on the enterprises of other contracting estate is ascertained as per the article of the business. PE is not a legal entity, but it is concept under the tax treaty. It is not a legal entity. If you take the PE, you can't find under DTAs. It is kind of the concept we need to use determine the whether there is a permanent establishment or not. Then there are some P's that you can physically find out. Then some concept we use to determine number of days, kind of thing, right? Then these then the while this concept I will explain this one uh, because if I start this one it will take more than 9, that is almost 9. Then I will explain this concept and we'll go with the mind map uh, the next session and we can finish it off in then non-resident and international taxation from next week, and we can go with the questions as well. I will share the questions in advance. You to have practice, and we can do the question in next week and to have a better understanding. So we'll meet with next session in non-resident taxation as well. We'll discuss the balance chapters as well. So stay safe. Good night.